Something is quietly changing for seniors who own their homes, and most people in this situation will not find out until the damage is already done. There is an IRS rule that applies directly to home sales, and it has the power to either protect hundreds of thousands of dollars or cost you that exact same amount if you get it wrong. Right now, thousands of retirees are making decisions about selling their homes without fully understanding how this rule works, and the consequences cannot be undone after the fact. If you own a home, if you are within 5 years of selling, or if you are helping a parent navigate this process, what you are about to hear could save you more money than almost anything else you will watch today. Before we go any further, hit that subscribe button right now. Not as a formality, but as an act of protection for yourself, because IRS rules change, legislation gets updated, and new exceptions get added every single year. The seniors who stay informed are the ones who keep more of what they earned. This channel covers retirement taxes, Medicare rules, Social Security changes, and income strategies in a way that is clear, direct, and built for real people in real situations. Subscribe now, turn on notifications, and let this channel be your personal early warning system for everything that affects your financial life in retirement. You have worked too hard to be the last one to know. Here is what I want to establish before anything else. Everything I am going to walk you through today is based on legitimate IRS guidelines that apply to homeowners across this country. This is not complicated theory or financial strategy reserved for wealthy investors. This is a real benefit built directly into the tax code that affects you if you own a primary residence. My goal today is to give you a clear and honest picture of how this rule works, what can go wrong, and what you can do right now to protect yourself before you ever sign a single document. You deserve to walk away from your home sale with everything you are entitled to keep. Now, here's the first thing I want you to hold in the back of your mind as we go through this. There is one specific time-sensitive window buried inside this rule that almost nobody explains clearly, and when seniors miss it, they lose money they could have kept with a simple awareness of the deadline. I am going to walk you straight to it. But to understand why it matters so much, you need to understand the foundation first. So stay with me. When you sell your home, the IRS treats the profit from that sale as a capital gain. That means the difference between what you originally paid for the house and what you sell it for is technically taxable income. For seniors who bought their homes 20, 30, or even 40 years ago, that profit number can be staggering. Without any form of protection, you could owe the IRS a life-changing amount of money just for selling the home you worked your entire life to own. But here is the protection the IRS built into the system specifically for primary homeowners. It is called the primary residence exclusion, and it allows you to shield a significant portion of your home sale profit from federal capital gains tax entirely. If you file your taxes as a single person, you can exclude up to $250,000 of profit. If you are married and file your taxes jointly with your spouse, that exclusion doubles to $500,000. For the average senior selling a home they have owned for decades, this exclusion alone can eliminate the majority of their tax liability, or in many cases, all of it. There is also a detail about Medicare that most people never connect to their home sale at all. Even after you apply the exclusion and reduce your taxable gain, a large enough sale can still reach into your finances 2 years down the road through higher Medicare costs. I am going to explain exactly how that happens and what you can do about it before we are done. But first, let me make sure you understand what you actually have to do to qualify for the exclusion, because none of the protection is available to you if you do not pass the eligibility test. The eligibility test has 3 parts. The first is ownership. You need to have owned your home for at least 2 years out of the 5-year period immediately before your sale date. It does not mean you had to own it for 5 full consecutive years. It simply means a total of 2 years of ownership, somewhere within that 5-year window. For married couples filing jointly, only one spouse needs to meet this part of the test, which is an important flexibility in situations where one person owned the home before the marriage began. The second part is residency, and this one carries more weight. You must have lived in the home as your primary residence for at least 2 years out of those same 5. Primary residence means the place where you actually live most of the time, where your mail arrives, where you are registered to vote, and where you spend the majority of your days. The IRS looks at a combination of real-world factors to determine this. For married couples, both spouses need to individually satisfy the residency requirement to qualify for the full $500,000 exclusion. If only one spouse meets it, the protection may be reduced to the single filer amount of $250,000, and that difference is not small. Something that surprises many seniors is that the 2 years of residency does not have to be one unbroken stretch of time. You could have lived in the home for 15 months, relocated temporarily, and then returned and lived there for another 9 months. As long as the total reaches 24 months within the 5-year window, you qualify. Short vacations and temporary absences do not count against you. You are not expected to be physically present every single day without exception. There is also an important provision for seniors who have had to leave their homes due to serious health challenges. If you lived in your home as your primary residence for at least 12 months and then had to move into a licensed care facility, such as an assisted living community or a skilled nursing home, due to a physical or mental health condition, the time spent in that facility can count toward your 2-year residency requirement. This means seniors in care situations may still qualify for the full exclusion, even if they have not physically lived in their home recently. That provision alone can make an enormous difference for families navigating one of the most difficult transitions a person can go through. If you know someone who is right in the middle of that kind of situation right now, maybe helping an aging parent sell a home after a move into care, would you consider sharing this video with them before they make any decisions? Knowing about this one provision early could protect a significant amount of money for their family. What would it mean to them to walk away with $250,000 more than they expected to keep? Now, let me pay off that first thing I told you to hold in your mind. The third part of the eligibility test is called the look-back period, and it is the one that surprises seniors the most because almost no one warns them about it in advance. You can only use this exclusion once every 2 years. If you sold another home and claimed this same exclusion within the 2 years before selling your current home, you do not qualify again. Not yet. This matters especially for seniors who have already downsized once and are now considering a second move not long after. If your first sale was 18 months ago and you already claimed the exclusion on it, you are sitting inside that 2-year window right now. Selling today would mean selling without the protection of the exclusion entirely, and depending on your gain, that could mean a tax bill that wipes out years of savings in a single transaction. Let me give you a real example so the numbers become concrete. Picture a couple. We will call them Frank and Diane. They bought their home 30 years ago for $160,000. Over those decades, they added a finished basement, replaced the roof twice, built a screened porch, and did a full kitchen renovation with new cabinetry and updated appliances. They sell the home today for $800,000. On the surface, their profit looks like $640,000. But every documented improvement they made raises what is called their adjusted cost basis, which reduces their taxable gain. If those improvements totaled $110,000, their actual taxable gain drops to $530,000. Since they are married and filing jointly, the first $500,000 is excluded entirely. That leaves only $30,000 as potentially taxable. At a 15% capital gains rate, they owe $4,500 to the IRS rather than what could have been over $90,000 without proper documentation. Every single receipt they held onto over 30 years changed the final number. Now let me address something that many seniors believe to be true, but is completely and factually wrong. And it is worth spending a moment here because this mistake is more common than you might think. A lot of people believe that if they take the money from their home sale and immediately buy another home, the taxable gain rolls over and gets deferred into the new property. That belief is based on an old provision that was removed from the tax code decades ago. Under current law, there is no rollover provision for personal residences. Whether you buy another home tomorrow, invest the proceeds, or let the money sit in your bank account, your tax situation at the moment of the sale is your tax situation. The only thing that actually shields your profit is meeting all 3 parts of the eligibility test. If you have been planning around a rollover strategy, you need to set that assumption aside completely and replace it with the correct understanding. There is something else I want to plant in your mind before we walk through the 5 most costly mistakes seniors make. There is an entirely different approach that some seniors use when their gain is large enough that even the full exclusion does not completely protect them. It involves thinking about the property differently, as something to pass on rather than sell. I will explain exactly how that works and when it makes sense a little later in this video. But first, let me walk you through those mistakes, because even seniors who qualify for the exclusion can still lose a significant amount of money by handling the surrounding details incorrectly. Have you ever sat down with a qualified tax professional specifically to review your home's improvement history and cost basis before listing it for sale? Or did you assume that part would take care of itself? Before I walk you through these mistakes, drop a comment below and tell me honestly whether you have ever had that conversation. I genuinely read the comments, and your answer helps me know what to cover more deeply in future videos. The first mistake is not tracking your home improvement costs over the years. Every meaningful project you completed, a new roof, a bathroom renovation, a room addition, a new HVAC system, upgraded windows, a resurfaced driveway, they all qualify to be added to your original purchase price to form what is called your adjusted basis. The higher that number is, the lower your taxable gain will be when you sell. Seniors who lived in their homes for decades without keeping records often end up paying taxes on tens of thousands of dollars in gains that could have been legally offset. If you still live in your home, start keeping records today. If you are preparing to sell and have nothing saved, work backward using old bank statements. Check your local government for any permit records, and contact past contractors to see if they have files on work they did for you. The second mistake is not thinking carefully about the timing of your sale. The calendar year in which you sell matters beyond just whether the housing market is favorable. If your gain will exceed the exclusion limit, selling in a year when your other income is particularly low can keep you in a lower capital gains tax bracket and reduce your overall tax bill. For seniors who have some flexibility in when they finalize a sale, being deliberate about the year and even the month can make a measurable difference. The third mistake involves the history of how you used your home. If you operated a business from your home and claimed depreciation deductions on your tax returns, or if you rented out a room, a floor, or a separate unit at any point during your ownership, those portions of the property may not fully qualify for the exclusion. The depreciation you previously claimed may also need to be added back as taxable income at the time of the sale, which is known as depreciation recapture. This catches a lot of seniors completely off guard, particularly those who ran home-based businesses during earlier years and assumed those deductions were simply past history with no future connection to their home sale. The fourth mistake is the surviving spouse deadline, and this one carries the highest emotional weight because it affects people at the most vulnerable point in their lives. If you recently lost your spouse and the two of you owned the home together, there is a window of 2 years from the date of your spouse's passing, during which you may still claim the full $500,000 exclusion, even though you are now a single filer. Once that 2-year period ends, you are limited to the $250,000 single filer amount. Waiting too long without knowing this rule exists can permanently cost you up to $250,000 in lost protection. You do not need to rush any decision, and no one should expect you to. But knowing the deadline exists means you can plan intentionally rather than accidentally let it pass. The fifth mistake is not budgeting for the Medicare premium impact, and this one catches seniors off guard approximately 2 full years after the sale is closed. Medicare calculates your monthly premium amounts using your income from 2 years prior. If your home sale created a large enough taxable gain that year, it can push your total income into a higher premium category, triggering what are called income-related adjustment amounts on your Part B and Part D coverage. The result is a meaningfully higher Medicare bill for an entire year, arriving in the mail long after you thought the home sale was completely behind you. Most seniors never plan for this, and the shock of seeing a dramatically higher Medicare premium notice without any obvious explanation is one of the more frustrating financial surprises in retirement. Let me show you what that looks like with real numbers. Consider a woman we will call Margaret. She is 70 years old, filing as a single person, and has owned her home for 22 years. She sells it for $540,000. Her original purchase price combined with documented improvements gives her an adjusted basis of $200,000. That means her total gain is $340,000. The $250,000 exclusion covers most of it, leaving $90,000 as taxable capital gains. At a 15% rate, her federal capital gains tax is $13,500. But that $90,000 of income also gets added to her other retirement income for the year, pushing her total into a higher Medicare premium tier. Her Part B premium rises by approximately $170 per month for the following year. That is over $2,000 in additional Medicare costs she never factored into her planning. A conversation with a financial professional before the sale would have given her the chance to either time things differently or set that money aside in advance. Now let me come back to that estate planning approach I mentioned earlier. Some seniors who have very large gains decide that selling the property during their lifetime is not the most financially sound option for their family. When a property is passed on through an estate rather than sold while the owner is living, the person who inherits it receives what is known as a stepped-up basis. That means the property's cost basis is reset to its current fair market value at the time of inheritance. If the heir then sells the property shortly after inheriting it, they owe very little or no capital gains tax because there is essentially no difference between what they received it for and what they sell it for. This is a legitimate planning approach, not a workaround, and it is worth discussing with an estate planning professional if you have substantial equity and sufficient retirement income to support yourself without the sale proceeds. Now I want you to look at one of these three situations and ask yourself honestly, which one fits you best right now? If you have lived in your home for more than 15 years, have done meaningful improvements along the way, and have been loosely thinking about selling someday but have never done any formal tax planning around it, you are in the most common position of all. The good news is that you almost certainly have time to prepare properly. Gather whatever records you can, estimate your rough gain based on current market values in your area, and schedule a conversation with a tax professional before you ever contact a real estate agent. The order of those steps matters more than most people realize. If you are a surviving spouse who lost your partner in the last 2 years, and you have not yet made a final decision about the home, your situation requires both compassion and clarity. You do not need to rush. You also need to understand that a financial deadline exists, and letting it pass accidentally could cost you a very large amount of money. A single conversation with a qualified professional about your specific timeline can help you make a truly informed decision, rather than one made only by grief and exhaustion. If you sold a different home recently, claimed the exclusion, and are now considering selling your current home because circumstances have changed, you need to know exactly where you stand in the 2-year look-back window before you commit to any timeline. Entering into a sale contract while still inside that window, without realizing the exclusion is temporarily unavailable, could mean your entire gain is exposed to taxation with nothing to shield it. Are you starting to see how many different directions this rule can affect your situation depending on where you are in life right now? Here is what I want to ask you before we move into the final section. Of everything you have heard so far, what is the single piece of information that felt most relevant to your own situation? Take a second and genuinely think about that, because your answer tells you exactly what to address first. Now let me give you something practical and specific. A set of actions you can take starting today with no cost, no appointment required, and no financial background needed. Start by locating your original home purchase documents and writing down the price you paid when you bought it. Then create a written list of every major project you have done to the home over the years, your best estimate of what each one cost, and roughly when it happened. If you have any supporting paperwork, receipts, contractor invoices, or permit records, pull them together and create a dedicated file. If you are married, sit down with your spouse and confirm that both of you have spent at least 2 of the last 5 years in this home as your primary address, because both of you need to meet that requirement individually. Make a note of any time periods where part of the home was rented out or used for a home-based business with claimed deductions, and flag that for your tax professional. If your spouse passed away within the last 2 years, mark that anniversary date clearly and determine how much time remains in the qualifying window. And then, before you make any final decisions about listing price, timing, or accepting an offer, schedule a consultation with a qualified tax professional who specifically understands real estate and retirement income rules. Let me bring the whole picture together now. The primary residence exclusion is one of the most valuable financial protections available to American seniors who own their homes. It shields up to $250,000 for single filers and up to $500,000 for married couples from federal capital gains tax on the profits from your home sale. To qualify, you need a minimum of 2 years of ownership and 2 years of primary residency within the 5-year period before your sale. You can only use it once every 2 years. Raising your documented cost basis through improvement records directly reduces your taxable gain. Timing the sale strategically can lower your tax bracket. In special life circumstances, including surviving spouse status, care facility residency, prior business use, and rental history, all interact with this rule in specific ways that are worth examining carefully with professional guidance before you act. Here is the final thought I want to leave with you. The seniors who lose the most money in a home sale are rarely the ones who made a dramatic, obvious error. They are the ones who assumed the details would sort themselves out, that someone along the way would tell them what they needed to know, or that the rules were simpler than they actually are. That assumption, quiet and comfortable as it is, can cost a family $250,000 or more. You have spent years or decades building the equity in your home. You paid your mortgage through every economic season, maintained the property through every stage of life, and made it into something real. You deserve to keep what you built. The tax code gives you the tools to do exactly that, but only if you understand them before the sale closes, not after. The decision about when, how, and whether to sell your home is yours alone. No rule, no deadline, and no tax bill changes that. But knowledge is what converts a well-meaning decision into a financially protected one. So here is my final question for you today. Now that you know this rule exists and exactly how it works, what is the very first step you are going to take this week to make sure you are fully protected before your home ever goes on the market?